This video is going to cover a lot of data related to the equity markets, and I'm going to show a bunch of charts from sentimenttrader.com and also show an Elliott wave type of view of the markets. And the first thing I'll start out with here is some WriteX fund flows. So again, WriteX is a family of funds that is really geared more towards short-term traders. You can move your money around in these WriteX funds without penalty. And so tracking what the people that have money in the WriteX funds are doing is going to be kind of a sentiment gauge in and of itself to see where the money's going within that group of funds. What this chart is showing is the total of unleveraged, just standard bullish market funds divided by bearish market funds. So down here you can see the ratio of assets in the bull funds to the bear funds, and whenever the ratio gets very, very high, that tends to correspond with market peaks or times where the market will be flattening out in the future. And the last time I did a video and showed this data was the beginning of June, which is the market was around this level. This is the S&P 500 here, and it had actually spiked to a very high level there. As of this past week, this ratio reached a level higher than it's been in the past decade. So we're seeing a definite shift, a decided bullish posture amongst the WriteX traders. And I'm going to show the chart of leveraged funds as well, and it's the same story here. This is showing leveraged bullish to bearish funds, and again we saw this past week this ratio reach a higher level than it has in several years. The prior corresponding peaks were the end of 2004, before the market went flat for most of 2005, and then we also saw a spike right as the bull market was topping in late 2007. There was a spike in this at the beginning of June before the little bit larger correction from June to July. So again, this is showing that there's a definite decided move to an extreme degree in these bullish funds, and from a contrarian perspective, you'd want to, at least I would want to consider betting against continuation of the trend when we've seen this type of movement to that degree. One other thing I want to show here are a few things regarding put and call ratios. I've showed this chart before. This is called the Robo put call ratio, but it's looking at very small option purchases, calls that are bought to open versus puts that are bought to open. This is the ratio up here. Right now it's not at the same level as it was back in the beginning of June. However, this is just the call purchases here on this chart, and we have seen call purchases jump up quite a bit in the last couple weeks. So I would like to see this ratio get up to an extreme degree before the market peaks, but if you look back at the chart, you can see that several market rallies the ratio has not really reached the upper trading band before significant correction, so I don't know that it has to get to that level. Now, here's a chart of the equity put call ratio. This is a 10-day average here. It's very, very high, the highest it's been in a few years, a couple years going back to near the top of the bull market. Again, when that ratio gets too low, if I said too high, excuse me, this is an inverse scale. So when that ratio gets too low, indicates complacency or lack of put buying. Now, this chart shows that equity put call ratio on a detrended basis. So what that means is it's showing the ratio, say, over the last couple weeks relative to the ratio over the last couple months. And whenever you see the recent data get very far from the longer term averages, that's helpful, and it often notes an extreme. And what we're seeing is recently this ratio has popped up around 15-16%, below the longer term average of the data, again indicating that there is some complacency or lack of put buying. Here's a chart, the spread between the OEX, which is this typically smart money options, and the equity put-call ratio. The smart traders will use these OEX options to hedge or speculate, whereas the equity is just showing calls and puts purchased or traded on any individual issues. And what this chart is showing is the difference between essentially the smart traders and the dumb traders. And what we're seeing is the 10-day average here as of this week is at a very high level, as high as it's been since actually near the bull market peaks in 2007. So starting to see the smart traders really protecting themselves by buying some puts, and the dumber traders really going crazy with the calls and buying puts to a much lesser degree. This chart is showing, again, what I've showed before. This is kind of a composite model of several different sentiment surveys regarding the stock market. And the last time I showed this was, again, the beginning of June, when this model was right here and the markets were around this area here. Since then, we've continued to see an increase in bullish percent among the major surveys, both in individuals and investment advisors. So again, this tends to be a longer term signal, and it tends to be best used going the opposite direction of the 200-day moving average. So if the 200-day moving average is pointing down, then you'd want to act on these signals where it's up above the red line. What we have right now is a 200-day moving average actually just flattening out within the last couple of weeks. Excuse me just for a minute. All right, I'm back. And so the takeaway for this is, even if we were to assume that this is a new bull market long-term uptrend, when the bullish opinion gets too stretched to the upside, you'll start to see strong trends turn into weak trends. And when you're in a bear market, you tend to very quickly see the market roll over from those levels. So in either case, this is just showing that largely investment advisors and individual investors are becoming quite bullish, and that could be a longer term contrarian signal. Now this chart is showing a measure of legal insider, corporate insider buying and selling, and the red lines indicate that the corporate insiders are selling stocks when they have the opportunity. There's only certain windows of time where insiders are allowed to exchange shares or buy or sell shares because of the inside information they have. So what we see is, as of this past week, the corporate insiders are selling to the highest level that they have been since the early 2007, prior to the bull market peak. So which to me that indicates that they don't have a lot of confidence that the earnings power of their companies are really rebounding, or that their share prices are going to be rebounded substantially in the near future anyway. So this is data that I haven't followed for a long time, but it tends to be, I would say, a little bit of a longer term signal, and might be telling in that those individuals or people involved with these companies have a better understanding of their business and what the actual prospects for recovery is than maybe we do, or maybe the media